Hi, today is Sunday, October 14th, 2018, and we're looking at a video for the S&P 500 as we go into week 3 for October, monthly OPEX week, and, and look to see if we're going to follow through further on this correction that we're in, or if we're going to bounce back. Before starting this video, I went back and I watched my own video that I made last Sunday and posted for you guys. And so I'm hoping that I can be a little bit more concise and not get stuck on too many tangents and get through this video a little quicker for you, be more concise on these in the future. And also, I also just wanted to look at it to see, what I was seeing then versus what actually happened. And I was kind of shocked at how very much things played out. And I don't mean that I predicted things. I mean that the technicals that I was pointing out to you on the chart really did follow through and really did give us a loud signal. And, we really had it laid out at our feet, the potential of what could happen. I didn't even imagine that we would get down to the lows that we did get down to, even though I pointed them out in that video. I didn't really think it would happen. But in any case, that is the whole point of why I keep a roadmap like this, is so that I have a record of anything and everything that could possibly happen to us with this index. And anyway, if you want to go back and rewatch that video, you can start from about 5 minutes in, and it's really something to see how things played out. Anyway, but here we are. This is what the roadmap looked like before all the selling occurred this week. I kept a version of it and kept moving the text notes over, but I kept giving you guys a fresh new copy that looks a little different. And so this is what the roadmap looked like. This was everything that we have gone through and taken out. And finally, the last thing that we took out all the way down here. I didn't even have it marked with like the purple stripes yet that I usually put on here to mark the gaps. But we came all the way down here and filled a gap all the way back to July 3rd, the start of Q3, July, August, the start of Q3. Anyway, but this is what the roadmap looks like now. This is with everything, all the congestion cleared out of there. All those notes and all those levels that we've experienced, chop and gaps and things like that around, they've all been cleared through, and now we have this wide open, breathable space in the center of the chart. We still have some congestion and some things to get through down at the bottom here if we're going to see further upside. And we have brand new gaps that are living now up above us that we've left in our wake since setting the all-time high and then getting into this corrective mode that we've been in October week 2. So this is what the roadmap looks like right now. This is the gap roadmap. And you can see that, here's a gap that here are the two new gaps that we have above us. But starting, once we filled this gap here, this first big gap that we spent the whole summer pretending we were going to go fill and then bouncing off of it and never really following through and filling it. Once we got through that, it was just like a hurricane. I'm sorry, that's like a terrible, terrible choice of analogies. Not like a hurricane, but just sort of like a truck drove through the chart here, and we went through all of the gaps all the way down, breaking the bottom of the rising channel that we're in, breaking through our 200-day simple moving average, and coming down to a point where, if you draw a trend line like this, we've kind of broken it. If you want to pick up a trend line and instead maybe draw it like this through the February and the April back test low, if you want to draw a trend line like that, then we would still have a ways to go before testing this, and that would take us all the way down to about 2640 and rising right now to go and back test that. So if you're into trend lines, there's your couple of possibilities there. But what I want to really focus on, I think is most important, is the fact that we came down through the 200-day moving average, simple moving average. That's always the pink line on all the charts I post. This is a chart with nothing on it but a 50 and a 200-day simple moving average. And we made one single close below it on Thursday, but on Friday, the cavalry rode in, and you can see that we came back to close just above that 200-day simple moving average. And when you back out the chart and you look at it, this entire year, we only closed once below the 200-day simple moving average and never followed through on it. And that was on April 2nd, the first trading day of Q2. Even in the heat of all this selling that was going on in January at our low, that marks our low for the year at 25.32, all that was an intraday poke through the 200-day simple moving average. And the closing low for the year was right here, but it was still well above the 200-day. So you had one single close here and never followed it through. And you can go through the chart here and look at that pink line. Okay, here was a back test, but a close above it. Here was a single close down below it. This was the Brexit fallout, 2 days of selling that happened around the Brexit vote in June, late June of 2016. You got to go back here to this blue square. And this is the big worldwide global market sell-off that happened, started in late 2015 and continued on into 2016. Started in late 2015 for the S&P 500, but it began in the spring. We had, Greek default. We had oil selling off from 104 all the way down to 42 bucks. And then we had a huge sell-off going on in China. They sold off down to 38% off of their market high and intervened in their currency. And that really just, then finally the U.S. got pulled into it. And we ended up, selling off in the late summer. We bounced, and we had our end of the year performance chase. But that really, topped out in early November, and then we sort of slid off. And then once again, the selling started again in January, and we sold off all the way down to 1810. And from there, we bounced. And in the midst of all that, just in this second half alone of that sell-off, we spent 48 closes in a row underneath the 200-day simple moving average. But after that, we made, like I said, Brexit was one single close below it. The elections in 2016 was no close below it. It was a save. You could see they came back at the end of the day and saved us from closing below the 200-day simple moving average. And then here, nothing even close until we get into 2018. Coming off of our all-time high, we poked through the 200-day simple moving average, and then here in April, that one single close, and then until this sell-off here that we're in right now. One single close, no follow-through. So that gives us a very clear line and signal to watch. And like I said, you want to go back to last Sunday's video, start in it at minute 5 and look at it, and then if you want to skip ahead once again to around minute 7, in that video, it's about a 12-minute total video. You can see that, and you can see how these simple moving averages told you exactly what to do and where to go. And in any case, we're getting a really great signal here that if we're going to put in 2 closes in below the 200-day simple moving average, we might be in for a much more serious downside than what we've already experienced. Okay, let's talk about the downside that we have experienced so far. This low has taken us down 8% from the all-time high. There is a thing that I learned off of Carter Worth a couple of years ago, and I wrote it down because I thought it really made a lot of sense. And in his life as a professional technician, he says that there is a behavior pattern that always happens in corrections. People always aim for this 5% off, and we never really get there. We only get to 3, maybe 4% at the most, because there are so many stops that sit there at that 5% off. It always inevitably overshoots and goes to 7 or 8%. And sure enough, this low that we made it down to is 8% off, and 8% off the all-time high. And when you go 29.41 minus 5%, you get, let's just call this 27.94. And 27.94, that's right about where our high retraced back to. After the open, we made it up to a high of around 27.94 on Thursday, and then failed that and ran through all the stops. And that's exactly why we followed through and we pushed down even lower on Thursday. We pushed, we tried to regain that 5% mark, And look where that lines up when you look left on the chart. It lines up with this high point that we reached in June. Couldn't get above there, so you can tell that this is right where a lot of stops were probably set up, and you know, and they were just plowed through. So we made it down to 8%. Okay. Now, what if this isn't enough to feed the beast? Because not only is that a nice little overshoot, but it's also sort of like the stopping point before you get to 10%. Because when you get to a 10% correction, there is also, you know, a whole set of stops sitting there as well, and we usually will overshoot that to 12 or 13% off. And if we go the full 13% off from 29.41, our all-time high, minus 13% takes us down to 25.58. And that's the reason why I started introducing the idea that we might be visiting a 2500 handle. 25.58 would take us down to back test and hold above this April low here, which is our back test low above the 2018 low of 25.32. If we only go down to 12% off, 29.41 minus 12%, that's going to get us to 25.88, and 25.88 would take us below this low here, but it would still hold above what's going on in these back tests of the back test. So I think that that if we're not going to hold this low over here that we've made so far down at 27.10, then we have to open our minds to the 2500 handle, and 25.88 to 25.58 or so, if we're going to match that behavior pattern of overshooting at 10%. Okay, so and a great way that we're going to know it's coming is on these breaks of the 200-day simple moving average, and if they can't get back and close back above them at the end of the day. And if we put 2 closes in a row below it, that is a huge break of a pattern that has been put in, and as you know, the chart has shown us through through the last 2 years, that they don't allow more than 2 closes, more than 1 close, below daily close below the 200-day, and we haven't seen that since that big sell-off in 2016. So you've got a lot of things there. Excuse me, personal photo there of my beautiful son. So that's the big downside move. Now, as far as bounces are concerned, because inevitably, what if this 8% is all that we've got in the bag right now, and that maybe this is going to be part 1 of our correction, and that maybe not until after January 1st are we going to come back and maybe go after that 2500 handle. If that's the case, then we've got a nice cleared out, thoroughly non-congested area of the roadmap now that we can look to. And the halfway back point right now from the low that we've made up to the all-time high would take us back to around 28.25. And I will mark that more clearly on this. Right now I don't have it. But right around 28.25, not only is that the halfway back of this whole move, but that's also the 100-day simple moving average. And it's also right around where the halfway back of this huge day is at. So a lot of stuff, almost a magnetic force that might draw us back up here to the 100-day and up to the area between 28.25 and 28.30. If we can bust up through that, we'll end up taking back the 10-day simple moving average and going for an attempt to take back the 50-day simple moving average. So as far as bounces go, first off, we'll look to see if all we're going to do is retrace back to the broken channel here and do a typical kiss back and die and come back down and maybe back test Friday's low, or even have to go back and back test Thursday's low one more time. If we bust right up on through this 27.95 area where we topped out on Friday, remember that's also about 5% off the all-time high. Maybe there are some short seller stops there. Maybe they'll be forced to buy back if we can break up above 27.95. If we can get past there, then we're going to go to 28.25 to 28.30. And if we can bust up through there, wherever the 10-day simple moving average is at that point, starting tomorrow, it's probably going to be all the way down here around 28.46. That was a trapdoor level where we really fell through the floor on Wednesday of this day, You don't really see it here on a daily chart, but if you look at an intraday chart, you'll see it. We had a long standing flat that really held us up, and then once that 28.46 level broke, we kind of like fell through the floor from there. So we're going to have our 10-day simple moving average sort of coming down to around there. And if it takes us a couple of more days to get back to 28.25 or 28.30, we're going to be met with the 10-day simple moving average by then, because it's moving pretty fast, and I would estimate that by Tuesday it's going to be right here. If we can get above the 10-day simple moving average, then we look for the 50-day and the 20-day. So use these simple moving averages, use this gap that's up here. Possibly what we're going to be looking for is that we're just going to fill this gap and then turn around and head back down. Or, like I said, maybe all we're going to do here is fight around here with the 200-day simple moving average and then push down again. But you have a lot of reasons why we might be done with the selling for now, and you have a lot of reasons why if we're not done with the selling, we'll clearly know it by a break of the 200-day, a break of this low, and know that, you know, even though we've got a lot of stuff to get through on the bottom of the roadmap here now, maybe it'll take some time and we'll chop around. But ultimately, if you're looking to buy some common stock, if you've had a list and some money you've wanted to put to work for a while, keep in mind that, you know, eventually, if we don't do it now, I think maybe after January 1st, we might pull back down to that 2,500 handle on the S&P 500. Just keep your list ready and put your money to work then. And don't get involved in chasing this back up. This is a great time for us to be trading options, trading earnings, and getting the most out of what we can of this bounce. Because inevitably we almost always sort of sell off at the beginning of January, and I can't imagine that this is going to be any different than anything else. Plus, we also have the elections coming up in November. There might just be a chase to that, and if there's a bad reaction to that, maybe just as how the 2016 the 2015 to 2016 correction, that I can show you that one more time, how that it'll be the very last chart that I put on. Oh, whatever. I can't figure it out. I don't know where it is right now. But anyway, that one, as I showed you earlier, that one started with a bounce that happened in the fall and culminated around November 3rd, and then sort of began to chop back down. And then we came in on January 1st, and the bottom fell out, and we had the entire correction all over again. So that might be the same kind of setup that we're looking for here. We might just rally until just right up into the election, and then after that sort of slowly fade away and then come in January and sell off. So don't think for a minute that we are completely done here. I do think that even if we come in tomorrow and rally on up high, eventually at some point at minimum we're going to come back and back test this low. If not, go even lower on down to that 2,500 handle, as I explained before. Okay, that's it. I hope this video was helpful. I hope it was a little more concise than last week's. And enjoy the rest of your Sunday. Good luck and good trading.